In today's macro analysis, we will take a look at the December PCE report and we will scrutinize the inflation metrics of that report. And the clear narrative that evolves from this data, when taking into account residual seasonality, when taking into account base effects, is a narrative of continued stickiness of inflation. And this continued stickiness of inflation, in combination with continued resilience of the US economy despite elevated interest rates, which ultimately leads to a rising estimate of the neutral rate of interest, when we take those factors into account, we end up in an environment where the Federal Reserve is likely to stay to keep rates at the current level for quite some time. But of course, in the current environment, one must also consider that the data is quite volatile. But in today's analysis, we will clearly extract an inflationary narrative from the data. Let's get to the analysis. As always, I will, show you the statistical coding part of the analysis here step by step. The first thing that we're going to do is we're going to import the different data sets that we're going to use in this analysis, and we're going to rename them accordingly. The historic data set includes historic data that will allow us to calculate the one standard deviation upper band, and of course also the mean, which is required to calculate the upper band. We also have a data set called data current, which allows us to assess the current data that was released as of that was released for December rather. And then we will also conduct a slight scenario analysis, and we will go over so-called residual seasonality. So let's import and rename those data sets. And then the first thing that we're going to do is we're going to assess core PCE inflation data. Core PCE is personal consumption expenditures, the price index, excluding the volatile food and energy prices, and it is the preferred measure of inflation of the Federal Reserve. So what we're going to do is here, we're going to take a look at the core PCE rate. We're going to create a chart for it. And we can see here that the core PCE rate rose by 0.2% in December, which was in line with expectations. Now, looking at the year-over-year rate, that was also in line with expectations. We can clearly see here that inflation seems to remain sticky at the current level. It becomes very interesting when we take a look at the 3-month annualized core PCE inflation rate. We can see that it has been coming down, and it is now at the lowest level since around June. And when we take a look at the 6-month annualized rate of core PCE inflation, we can also see that it fell in December. However, this annualized rate may be a bit misleading. There are two issues that we're dealing with here. The first issue is base effects. Essentially, inflation, of course, has come down quite a bit in 2024, which means that in order to get inflation closer to the 2% target or to the 2% target, we need to see more favorable month-over-month readings than what we would have qualified as favorable last year. So the first analysis that we're going to look at is what will happen or what would happen to the year-over-year core PCE inflation rate if we see average growth of 0.2% month over month, a rate that we certainly would have qualified as, very benign throughout 2024. And when we run this code with the scenario analysis, we can see that at the end of 2025, if core PCE on average rises by 0.2% month over month, we end the year clearly above the 2% target at around 2.6%. And we would be going sideways from here in this scenario. Now, a 0.3% month over month increase on average would cause quite a significant rebound in inflation, especially towards the end of 2025. Now, an optimal rate would be, and this is what this chart shows you, an optimal average growth rate would be 0.15% month over month, but that is a very benign rate. And when you consider that, of course, the expected disinflation in housing will not impact PCE as much, it will impact mostly CPI, close the delta, narrow the gap between the CPI and PCE inflation rate. And then when you consider that spending still remains very, very resilient, economic growth remains very resilient, it seems to me reasonable to expect that the average growth rate in core PCE will exceed 0.15%. And we already know that at zero point 0.2, we're basically going nowhere from here. And that certainly supports a more prudent approach from the Fed towards rate cuts. And when you take a look at the second issue, this applies to January specifically, is residual seasonality. What is residual seasonality? Residual seasonality is essentially the seasonality that remains when we seasonally adjust the data. It's essentially an issue with the seasonal adjustment in the original data. In order to assess this, we of course convert the core PCE data to a time series object in the RStudio environment, and then we can plot this chart. And this chart shows you the average month over month change in core PCE using data from 2000 to 2024 for each month. And you can clearly see it is not the same, which means that there is some residual seasonality left, because if there wasn't, these averages should equal this, it should be the same across the year. Um, and when you take a look at January, it's usually the highest. So we tend to see a stronger month over month increase in January compared to some of the other months of the year, which means that in January we may well get a increase in core PCE above 0.2% month over month, which is too high and which would likely support hawkish rhetoric from the Federal Reserve. And we can conduct the very same analysis using, of course, the headline rate. When we take a look at the month over month rate, we can see that it rose by 0.3% month over month in December. And when you take a look at the year over year rate, we have seen a steady reacceleration, a steady rebound in the year over year headline PCE rate. And when you take a look at the 3-month annualized, we also saw an increase here in December. And we will deal with the same base effect problem for headline PCE. When we assume a 0.2% average increase, we're basically going nowhere by the end of 2025. When we assume 0.3%, we see a significant rebound above 3% by the end of this year. So really 0.15 on average is what we need in order to make further progress to the 2% target, or at least something below 0.2% month over month. And then we have the same residual seasonality issue where in January we tend to see slightly stronger data. Now, consumer spending, I'm going to run this code all at once. We're going to run this part first. Consumer spending remains resilient. It was strong in December, and it validates the very strong increase in consumer spending that we saw in Q4. Consumer spending has now been above the 1 standard deviation upper band from 2010 to 19 for 2 consecutive quarters. And we can see that in December, it was above the average and very close to the 1 standard deviation upper band. And when we do the same analysis for the year over year rate, we can clearly see here that it is still quite strong. And we can also see that we're very close here to the 1 standard deviation upper band. Now, growth in real disposable income was not as strong. We can see here that it has now decelerated for 3 consecutive months. And when we take a look at the average from 2010 to 2019, we are quite a bit below the average month over month growth rate in real disposable personal income, which signals to me that consumer spending is, of course, not growing by that much at the moment on a month over month basis. And we can observe the same thing on a year over year basis, where we are seeing this deceleration in real disposable income growth. And now you may wonder, what is financing all that strong spending that we're seeing? Well, it is a depletion of savings. That was certainly the case in December because when we take a look at the saving rate here, we can clearly see that it continues to drop. So what's the bottom line here? Well, the bottom line is that the December PCE report supports the narrative that economic growth is still strong, inflation is sticky, and it hence ultimately supports a higher for longer approach from the Fed, a more prudent approach from the Fed, and taking into account these base effects and residual seasonality, we should likely prepare ourselves for some hawkish rhetoric from the Fed in February and March. That was it for today's analysis. Have a fantastic rest of your evening.